try to live off dividends with just the S&P 500, well, you need millions up front and about 50 years of patience. More time and money than most people can actually commit. But what if I told you there's a way to speed that up? A way to hit that same $2,800 a month dividend income goal in less than half the time? In this video, I'll show you exactly how. Starting with just $10 a day, I'll walk you and John through a custom dividend portfolio designed to grow income faster than the S&P 500 ever could. And at the end, we'll do a side-by-side comparison so you can see how this strategy reaches the finish line 30 years earlier. Setting the stage. If your goal is $2,800 per month, that's about $33,600 a year in dividends. So, how much money do you actually need? That's where dividend yield comes in. At 3% yield, you'd need $1.12 million. At 4% yield, $840,000. At 5% yield, only $672,000. See the difference? Optimizing for yield matters a lot, but yield alone isn't enough. The real secret weapon in dividend investing is dividend reinvestment. That's when you use the dividends you receive to buy more shares, which then earn you even more dividends. It's the power of compounding in action. And while it doesn't look dramatic in the first couple of years, over 10, 20, 30 years, it snowballs into something huge. Why the S&P 500 is too slow. Now, let's talk about the S&P 500 ETF, better known as SPY. It's reliable, safe, and has built wealth for decades. But if your goal is income you can actually live on, SPY falls short. Here's why. The average yield is just 2.5%. That means on $100 invested, you earn only $2.50 a year in dividends. So yes, after 51 years, you could finally earn about $34,900 per year in dividends, just enough to hit that $2,800 per month target. But for most people, waiting half a century isn't realistic. To make it function, you need a portfolio with the right dividend stocks. I'll show you how a tailored dividend portfolio can streamline this process, cutting the amount of time and capital needed to reach $2,800 per month. In the end, I'll show you how this portfolio will get you the fastest route to $2,800 per month. In fact, it'll achieve that mark in just 20 years, which is less than half the time of an S&P 500 ETF. Now, when it comes to building a dividend portfolio that performs, not all dividend-paying stocks are created equal. It's not just about grabbing the highest yield you can locate. What you really want is equilibrium. You want income, sure, but you want dependable income. Income that expands, income you can rely on. And to get that, there are a few key things you should be searching for. First, there's dividend yield. This tells you how much you're earning on each dollar you invest. It's important, but it's only one part of the story. Chasing high yields alone can be a pitfall. Some stocks pay extremely high dividends because their price is falling or their business model is unstable. And that's a red flag. If a company can't maintain its payout, the dividend might get cut, and that income stream could vanish overnight. That's why dividend growth is such a powerful indicator. When a company regularly boosts its dividend year after year, it's often a sign of strong earnings, responsible management, and long-term profitability. A company that grows its dividend 10% or more each year is compounding your income in a way that's just as potent as reinvestment. Next, I look at payout ratio. That's the percentage of earnings a company uses to pay dividends. A healthy range is usually under 60%. It shows the company isn't stretching too far to reward shareholders and still has money to reinvest in its own growth. You also want to think about stability. Has the company paid and increased its dividend through different market cycles? If they've kept paying during recessions or downturns, that's a strong sign they'll continue to do so in the future. And finally, there's diversification. A dividend portfolio shouldn't be concentrated with companies from just one industry. Spread your investments across different sectors like financials, healthcare, consumer staples, and even real estate to minimize risk and improve steadiness. Certain sectors like REITs are especially appealing because they're required by law to return a large portion of their profits as dividends, making them natural income producers. When you put all of that together, good yield, strong growth, smart payout ratios, proven consistency, and solid diversification, you're no longer guessing. You're constructing a system, one that's designed to grow your income year after year and get you to that $2,800 per month, aim faster than most people think is even possible. So, now let's put the strategy into practice. What does a real-world dividend portfolio look like when it's structured for maximum growth, strong income, and long-term dependability? Well, here's a portfolio that's been built using all of those principles. It starts with the Schwab U.S. Dividend Equity ETF with the ticker symbol SCHD. This acts as the core foundation of the portfolio. It's got wide diversification, a 3.8% dividend yield, and it's laser-focused on quality companies with consistent cash flow. It doesn't just give you stability, it gives you performance too, with an average annual dividend growth of 10.77% and a solid 7.87% average share price each year. Then there's the Federal Agricultural Mortgage Corporation with the ticker symbol AGM. While it might not make headlines, AGM delivers big where it matters. Its income stream is steady, and its business model is built for durability, with a financial performance that continues to push both dividends and value higher over time. Its numbers are impressive: a 3.46% dividend yield, a massive 25.47% average dividend growth rate, and 20.69% annual share price appreciation. Next is Interparfums with the ticker IP, which brings a different kind of strength. As a global fragrance company, it combines niche branding with dependable financial results. It's the kind of company that might fly under the radar, but continues to expand year after year through smart expansion and reliable profits. It shows a 2.41% dividend yield, a strong 20.26% dividend growth rate, and a 16.08% annual share price appreciation. Next up is Morgan Stanley with the ticker symbol MS, adding heavyweight credibility. As a major player in global finance, it has the reach, the reputation, and the results. Its dividend growth demonstrates itself, 23.45% over 10 years, alongside a 2.86% dividend yield and 13.41% annual share price appreciation. It's a steady and influential contributor to the portfolio's income and growth. And finally, there's AbbVie with the ticker symbol AbbVie. Healthcare is always in demand, and this company is a dividend powerhouse. It has a 3.51% dividend yield, a 12.86% dividend growth rate, and 10.38% annual share price appreciation. It offers both income security and defensive strength, even in turbulent markets. Next, let's see how to find your portfolio metrics, starting with the dividend yield, and it's fairly straightforward. First, you take the current dividend yield of each stock in the portfolio. SCHD at 3.8%, AGM at 3.46%, IP at 2.41%, Morgan Stanley at 2.86%, and AbbVie at 3.51%. You add all these yields together, which gives you a total of 16.04%. Then, since you have 5 stocks, you divide that number by 5. The result is 3.21%, and that is your average portfolio dividend yield. You can apply the exact same method to calculate the portfolio's average dividend growth rate and share price appreciation. So your final portfolio averages are 3.21% dividend yield, 18.56% dividend growth, and 13.69% share price appreciation. Now that you've seen the portfolio, the big question is, how quickly does it reach your income goal? Well, let's say you start with nothing but commit to investing $10 a day. By the end of year 1, you would have invested $3,650. This sets the foundation for future growth. By year 5, your portfolio will be valued at $25,797. By year 10, the portfolio value will reach $85,768. Fast forward to year 15, and it'll be at $234,943. And finally, by year 20, the portfolio value would hit $634,925, and your annual dividend income would hit $41,126. That's about $3,427 a month completely from dividends. The $2,800 per month income goal accomplished. Now, here's the part that really puts this strategy into viewpoint. Let's stack it up side by side against the traditional path, the S&P 500. Everyone knows the S&P 500. It's got a reputation. It's diversified. It's provided steady returns for decades. And honestly, if your goal is to build long-term wealth gradually, it is still a solid choice. But if your goal is income, monthly income, that's where it starts to lag. With an average dividend yield of just 2.5%, SPY simply doesn't pay out much. Even if you're religiously reinvesting every dividend and contributing like clockwork, it takes a long time to build serious income from it. In fact, as we mentioned earlier, you need to stick with it for 51 years to reach $2,800 per month in dividends. Now, compare that with what this tailored dividend strategy delivers to reach the same goal, or in fact, a better one. It took only 20 years. It reached a better target in less than half the time. This dramatic reduction in time comes from how the portfolio is built deliberately with speed in mind. Higher starting yields, fast-growing dividends from names like AGM and IP, and steady reinvestment all work together to create an accelerating compounding effect. Instead of relying mostly on price gains like the S&P 500, this portfolio grows income from the inside out. A 3.21% starting yield and 18.56% dividend growth mean your income multiplies faster with every passing year. Reinvested dividends buy more shares, which pay even more dividends, and the cycle snowballs. That is why this strategy reached the goal in 20 years, not 50. Same goal, less than half the time. Want to know how to turn a $20 weekly investment into a portfolio that pays over $70,000 in monthly dividend income? Click the video on the screen.